Selling options is a sophisticated trading strategy that allows investors to generate income, manage risk, and take advantage of market inefficiencies. At its core, selling options means you are writing contracts that give another trader the right to buy, call option, or sell, put option, an underlying asset at a predetermined price before a specific expiration date. As the seller, you collect a premium upfront, which represents your maximum profit. However, selling options also comes with obligations. If the buyer exercises the option, you must fulfill the terms of the contract, which can expose you to significant risk depending on the strategy used too. There are two primary types of options you can sell: calls and puts. Selling a call option obligates you to sell the underlying asset at the strike price if the buyer exercises the option. This strategy is commonly used when you believe the asset will remain flat or decline slightly. If you already own the asset, this is called a covered call, which is considered a conservative strategy because your risk is limited to missing out on potential upside. On the other hand, selling a naked call, where you don't own the underlying asset, is highly risky because your potential loss is theoretically unlimited if the asset's price surges. Selling put options obligates you to buy the underlying asset at the strike price if exercised. This strategy is often used when you're bullish on a stock and would be happy to own it at a lower price. A cash-secured put, where you set aside enough capital to buy the stock if assigned, is a safer approach than a naked put, which can expose you to large losses if the stock plummets. Several advanced strategies build on these basic concepts. The covered call is ideal for generating income from stocks you already own, especially in sideways markets. The cash-secured put is useful for acquiring stocks at a discount while earning premium income. The naked call and naked put are speculative strategies that require precise market timing and strong risk management. More complex strategies include credit spreads, which involve selling one option and buying another with a different strike price to limit risk. For example, a bear call spread profits when the stock stays below a certain level, while a bull put spread profits when the stock stays above a certain level. These spreads cap both potential profit and loss, making them more manageable for retail traders. 3. Other premium selling strategies include iron condors and iron butterflies, which combine multiple spreads to profit from low volatility. These strategies involve selling both calls and puts at different strike prices, creating a range where maximum profit is achieved if the stock stays within that range. Calendar spreads and diagonal spreads use options with different expiration dates to take advantage of time decay and volatility shifts. Selling options around earnings reports or major news events can be lucrative due to inflated premiums, but it also carries higher risk. Traders often use volatility indicators like implied volatility in the Greeks, delta, theta, vega, and gamma, to assess risk and reward. Theta, in particular, measures time decay, which benefits option sellers as the value of the option erodes over time. Successful option selling requires a disciplined approach. Traders must carefully select underlying assets with high liquidity and acceptable volatility. Strike price and expiration date should align with the trader's market outlook and risk tolerance. Position sizing, stop-loss orders, and rolling strategies are essential tools for managing trades. Rolling involves closing an existing position and opening a new one with a different strike or expiration to adjust risk or extend duration. Many professional traders treat option selling like a business, focusing on consistency, capital preservation, and exploiting inefficiencies in pricing. Selling options is not about predicting market direction perfectly. It's about structuring trades that offer favorable odds and managing them with precision too. In summary, selling options is a versatile and potentially profitable strategy when executed with knowledge and discipline. From basic covered calls and cash-secured puts to advanced spreads and volatility plays, the key is understanding the mechanics, managing risk, and aligning strategies with your market view. It's a game of probabilities, not certainties, and those who master the nuances can build a robust income-generating portfolio over time.